Yeah, so I think clearly India will obviously be far more resilient as compared to most of the global markets, even in 23. And there are a couple of reasons for it. I think the first reason is unlike, the global inflation that we saw last year in the United States and in Europe as well, India has managed its inflation far better as compared to most of the global markets. And hence that's also pretty much visible in the debt market volatility and the way RBI has been managing rates for that matter. The second important point is if you look at from 2010 till now, the global debt to GDP is up 50%. But for India, the debt to GDP is actually flat from 2010 till now, which essentially means that India over the last one decade is in far better position as compared to global markets in terms of any external volatility that we might see. Third point is, I think if you look at the bank's balance sheet in India, they are far more robust right now. If you look at provision coverage for PSU banks as well as private banks, they're at very, very healthy levels. And in fact, if you look at the net NPA levels for most of the banks across the board, whether it is private or PSU, are actually at substantially lower levels, even if you compare that with, say, a 5 or a 6-year-old numbers. And hence, we are seeing credit growth coming back to the tune of 15 to 17% this year. And I think you will at least continue to see 13 to 15% kind of credit growth over the next 2 to 3 years. So clearly, I think there will be premium associated with India as far as multiples are concerned, primarily because of the strong fundamentals that it actually possesses. I think there are 3-4 structural trends that I generally see in Indian economy. I think first is digitization. I think the way India has adopted digitization is far much quicker than anyone would have anticipated. The second important trend which I continue to see today is significant amount of focus on the EV penetration in India. We've seen a lot of auto companies focusing on EV in a significant fashion. I think that's a big trend to really play out for as we kind of really go forward in the next 2 to 3 years. The third important thing that I think India has really kind of gone through is there is significant amount of changes that we are doing on the banking and then the NBFC side in terms of a lot of policy action changes which has really happened. Like, for example, if you look at the UPI movement that India has, now we have seen the ONDC movement, which is likely to catch up in the next 3 to 5 years. I think all of them will actually ensure there is a significant vibrant economy, not only on the existing guys, but also on the startup guys, which I think is the third biggest trend that I continue to see in India at this point in time. Yeah, so I think from a theme perspective, there are multiple themes that we essentially like in India. I think the first is the EV theme, which clearly I think will dominate over the next 3 to 5 years. And I think there's a significant size of opportunity for the newer players to come in and kind of disrupt the entire marketplace, which today was actually virtually catered by a few large guys today. So that's, I think, is one big opportunity that we are really aspiring for. The second big opportunity, which I think is the insurance space, where I think the penetration of insurance is extremely low in India, and there's significant amount of room for that penetration to really move up over the next 3 to 5 years. The third important thing, which I really believe is playing out in a substantial fashion, is the entire capital goods sector space, the entire capex theme, primarily driven by PLI. Second is higher capacity utilization across most of the sectors, which I think is clearly going to drive a substantial amount of growth over the next 3 to 5 years in that particular sector, given the way environmental clearances are at a 10-year high. If you look at most of the order books for most of the capital good companies at a decade-year high, clearly gives us that confidence that this is a sector to really watch out for over the next 3 to 5 years. I would say that mid-cap should really be a part of the core equity allocation. If you look at data from 2004 till 2022, or if you look at data from 2012 to 2022, any duration, you would actually see that the best performing index is the mid-cap index, not the small cap, not even the large cap index. Two reasons for that. I think mid-cap index is actually in a far more sweeter spot. Primarily because the lowest market cap typically starts at close to 15,000 crores today, and the highest one is at 50,000 crores today. So on an average, assuming a 30p multiple, the average the average profit of most of these mid-cap companies close to 500 crores, which essentially means they would have seen multiple cycles to come to this level, and the ability for them to withstand external shocks is far better than any other small cap company to that extent. If you compare that with large cap companies, given the size of these companies are in the range of 500 to 1,000 crore profits, there is a potential for them to become the future large caps of future. So I essentially believe that mid cap is in a sweet spot where the drawdowns are far more lower as compared to small caps, and the upside are far more higher as compared to even small cap and large cap, both of them put together. So I think one really needs to have a very large allocation to mid cap, followed by small cap, and then to large caps. So I think if you look at the longer term period, I think there is no one particular style which really outperforms at all points of time. So you would not see a growth strategy really playing out for 20-year period or a value strategy playing out for a 20-year period. I'm of the firm belief that there's nothing called as value investing or growth investing. If you look at most of the PSU banks, which today were so-called as value investing or under classified under value stocks, are essentially doing extremely well today once there is growth and profitability. So it's only when growth really comes up, the stock price really start moving northwards and not anything else. So if you ask me still a question between value versus growth, I would definitely prefer growth. And in my opinion, that in any environment, be it today or 20 years down the line, if a particular company continues to grow at a faster rate of more than say 25 to 30%, it's bound to see a significant amount of improvement in market caps as well going forward. So I would strongly believe that growth is the way going forward, and that's the style that we as a house do follow as well. Yeah, so my first multi-bagger stock was Tube Investments. We started, it's almost been a six-bagger for us. This point in time, and our reason was very simple. We could clearly see that the EV penetration in India is going to pick up dramatically faster than most of us would have envisaged. Second important point when we looked at Tube Investment was that company was investing into EV 3 years before anyone else had decided to even invest in that business. Third point was that they were not only investing in EV business, but also investing in medical device manufacturing, which was completely imported today and will now move to import substitution. The second thing was they also are investing into mobile component manufacturing, which today is again completely imported, and hence there's an opportunity for import substitution there as well. The third important point, while they were investing in some of these new businesses, which I just alluded to, at the same time, the existing business where the margins were 4 to 5% were about to improve to 14 to 15% over the 3 to 4 year period. And hence, in the last 2-3 years, most of that has played out. The existing business margins have moved from 4 to 5% to almost 14-15%. The EV products have just got launched last quarter, and you will see more product launches going forward. And third thing is on medical devices and mobile component manufacturing, the entire story is yet to play out. And I think given those three elements playing together in a very synchronized format, we have seen more than 25 to 30% earnings growth in this company over the last 2 to 3 years. Oh, so actually, yes. So actually, once when I was a child, in 8th standard, my dad took me to his office, and he's a chartered accountant, so he used to invest in stock markets before he got retired 3-4 years back. So when I just went to the broker along with him, and I actually saw that a lot of people were making instant money, and I thought this is like the best possible category where you just don't have to put any capacities, no plan, nothing, and you just make instant capital. And instant profits. So that really got me fascinated to this category at the first place. And obviously, when I used to be a student in Podar College, when I used to do my BCom, I also used to do investing, right? But I always used to think about that I need to make money much more faster, right? And I also had substantial amount of losses during trading mindset when I was a young kid, right? And at a very younger age, I realized that you can't make money through trading, right? You can only make money through long-term investing. And it's only you realize only after paying tuition fees, right? So I have paid a decent amount of tuition fees when I was in 11th standard or 12th standard. And my dad used to be really cribbing about me, saying that, why are you even focusing on stock market? Focus on something else. But then I changed my thought process completely, and I decided that I will only look at longer term investing. Even today, most of my personal wealth goes into the mutual fund of the schemes that I manage, and most of the other money, whatever I left with, essentially go into investing, but again with a 5 to 7 year mindset, nothing below 5 to 7 year mindset. So this is broadly, I think, the biggest learning that I had over the last few years, and this is actually hold me in good stead.